Brittany, I will let you go ahead and share before we get started. I think you're on mute. Okay, very good. Okay, we're going to go ahead and get started. It's right at noon. I'm sure we're going to have some participants that are going to be floating in as I go through some of these housekeeping items. But first of all, I would like to welcome everyone to this afternoon's SCORE workshop, which is entitled Small Business Lending 101, and it's presented by Brittany Hilbert from Pinnacle Financial Partners. And before I turn it over to her, let me just go through some quick housekeeping items. First of all, everyone is muted currently. If you need to ask a question, please use the Q&A or the chat box. The slide presentation and the workshop recording will be sent to all registered participants. And I typically will do that within a couple hours of the conclusion of the workshop. So you can look for that. There will also be a questionnaire or survey that will be sent out, and we would appreciate your time in completing that. Brittany, I'll let you go. Oh, there we go. Okay, and I did not introduce myself. My name is Lori Stein, and I am a SCORE volunteer. And for those of you who are not familiar with SCORE, I just wanted to give you a brief intro here. We are a nonprofit and 100% volunteer-based organization. We are a resource partner of the SBA, and we provide educational workshops as we're presenting today. And we also do one-on-one mentoring. And that is a free service that we provide. And we have a slew of experts, volunteers that can provide you mentoring in any given area. And we typically will assign you a mentor, and then if there's an area that they do not have expertise in, they will pull somebody in to assist you. So please, if you're interested in that, you can visit our website and sign up. And I will also be sharing a little bit more information at the end of the workshop. We are here to assist small businesses in any way we can through these workshops and our mentoring. And again, our website is piedmont.score.org. And I will be sending this presentation out at the conclusion. So now the title again is Small Business Lending 101. And I will turn it over to Brittany, and she will take it from here. Thanks, Brittany.
Perfect. Thank you, Lori. As Lori said, I am Brittany Hilbert. I am a business banking financial advisor at Pinnacle Financial Partners. We're a regional bank headquartered out of Nashville, but we have 6 offices here in the upstate. We primarily work with businesses and business owners as the first kind of people we go after, I guess. And then from there, we're able to help them with services for their employees and things like that. But a little bit about me. This is my family. So my husband and I live in Simpsonville, and I have a 9-year-old daughter and a 10-year-old daughter. She just had a birthday, and a 6-year-old son. So they are in elementary school down at Plain. And I've been in the industry for over 10 years. So I am passionate about helping small businesses access capital to grow their business and achieve their financial goals. And one thing that I've found just in working with business owners for so long is a lot of times people are pretty familiar with a mortgage. They're pretty familiar with maybe a credit card or a home equity line of credit. But when it comes to the business lending piece, a lot of time business owners know they need capital, but they're not really sure what's available or what steps they need to take to get there. So hopefully today we'll go over some of that. And at the end, if anyone has questions, happy to answer them. So to get started, just a high-level overview on the types of loans that businesses are typically going to be utilizing. So very common, especially for businesses that have inventory or businesses that offer terms to their service, to their clients. So businesses that produce a product and then get paid 30 days later, or somebody that is going in, providing a service, they maybe get a portion up front, but then they're providing, they're paying the bills until that final payment. So for those clients, business lines of credit, you can do those two ways. So you can do them using a personal residence. This is a fantastic way to get capital for a business if you're doing a startup. On those, the loan is typically going to revolve for 10 years, which means for 10 years, you can pull money off the line and then pay it back, and then pull money off the line and then pay it back. At the end of that 10-year period, the loan will term out. So then you would go into 10 years of a set repayment, very similar to a traditional mortgage where you would have a principal and interest payment due monthly. And at the end of that 10 years, it would be paid off. So again, businesses that are starting up typically use this because it's an easy way to access that equity in your house in order to get capital to do a startup. The other way you can do a business line of credit is on accounts receivable. And then another common term, another product for businesses are going to be business term loans. So business term loans are going to be something that have a set repayment period, depending on what your collateral, or if there's collateral, will typically determine how long that loan goes out. So I put under here, usually under $50,000, banks are going to look at those loans as an unsecured loan. And most of the time they're going to want to see those on 3-year terms, maybe 4, if we've got some really good borrowers or a really stable business. And then equipment. So oftentimes businesses have large equipment purchases. And for businesses, sometimes that includes a vehicle. Sometimes that includes some specialty vehicles. So I think there's a lot of businesses that utilize maybe a modified like Sprinter van, or trucks that have different attachments put on the back, things like that. So when we're financing equipment, we're usually going to look at the useful life of the product. So some of your bigger machines, CNC, things like that, they're going to have longer useful life. So we can usually get those, 5 years, 6 years on a term loan, which helps from a cash flow perspective, because the longer the term, the lower your payment's going to be. And then another common term loan that businesses use is going to be for real estate. So when businesses decide they want a permanent location, they don't want to rent, they want to start building equity for themselves, we typically see them start to buy real estate. And real estate can also include construction. So then another type of product is going to be an SBA loan. So an SBA loan is typically done through a partner bank. And so Pinnacle is what's called a preferred lender from the SBA. That means that we've been vetted by the SBA. They allow us to use our own underwriting process, as opposed to having to send loan documents and loan packages off to the SBA to be approved. So oftentimes that results in a faster approval because we're able to do everything in-house. And if you go to the SBA's website, they'll have a list of partner vendors, or of approved lenders. And that's a good indication when you're on that list, that's a good indication it's a great bank to go to for an SBA loan. Pinnacle participates in 2 SBA programs, the first being the SBA 7A. This is by far the most common SBA product that's utilized. It's fantastic because we can go 90% loan to project. So a lot of times when you have somebody, they're maybe buying a building, but they also need to do an upfit, or they're buying a location and they also need equipment for that location. The SBA is able to do all of those things with one loan. So instead of having multiple loan payments due every month with different amortization schedules, they're able to wrap it all up into one project and then do one loan with one set amortization schedule. And those products, that 7A product is anywhere from $250,000 all the way up to $5 million per borrower. So the SBA does cap the amount that a single borrower is able to have loaned out at one time, and at $5 million. And again, this can be used for a variety of things. So startups, if you're buying a business, so if you've got a business and you have a competitor and you are trying to buy your competitor out, this is a great option. Or if a business has a long-time manager of the business that's wanting to buy out an owner who maybe doesn't have a family member that's looking to take over. This is a great option as well as equipment, real estate, build outs. And when they do those project factors, they'll also include working capital. So you can roll some of that in there. And then, like I said, it's one loan with all of the different pieces rolled into it. So from a business owner's perspective, it's super clean on your books. It's not confusing because you don't have multiple loans out there. It's one. And then the term's going to be 7 to 25 years, depending on that collateral. So startups and acquisitions are typically a 10-year term, whereas real estate, anything that is 50% or more real estate backed, they can typically take those out to 25 years. The second SBA product that we participate in is the 504. This is a little bit less common, and it's because it is usually structured as 2 different payments. And that's because instead of doing the entire loan funded through our capital, we partner with what's called a CDFI, which is a Community Development Financial Institution, and they own 40% of the loan. And so you would have a payment to the CDFI, and that's typically on a 10-year term with a full 10-year prepayment penalty. And then 50% the bank would own, so you would make a payment to the bank, and then 10% of the project would be owner equity. So you really see this 504 product really used for loans over $1 million, so in that $1 million to $5 million range. And usually it's for large equipment or real estate. This is not typically utilized for things like startup or acquisitions. So then kind of getting into the process. So you own a business, you have decided that you need to borrow money. What does that process look like? So I tell clients really the first thing should be a conversation with your banker. You should sit down and be able to tell them what the plan is, what you're looking to borrow money for, what you are planning to do with that money. And this is where business lending really differs from consumer lending. So anyone that's bought a house, you turn over your W-2s or your tax returns to the mortgage lender, and then they come back and they say, you're approved to buy a house up to $300,000. And then you take that pre-approval and you go look at houses within your price range, and you kind of know where to start. In business lending, it's a little different. So we typically want to know, how much do you want to spend? What are we going to be using the funds for? That way, when you come to your banker, you really have that plan laid out, because then what we're going to do is we're going to take that plan and we're going to collect all of your financial documents. So usually a financial package is going to consist of 2 years of tax returns. So that's going to be business and personal if you are an existing business. If you're a startup and you're looking to start up a business, they probably will want 3 years of personal returns. If you are buying another business, they will also want tax returns from the business that you're buying. That's to protect you, the purchaser, just as much as it is to protect the bank. They want to make sure that the business you're buying is viable, it is able to continue, and things like that. So then the other thing is they're going to want a current year financial statement. So that would be either year to date, meaning, today is October. So that would mean October's financial statements, all of 2022, or usually they will back it up to the most recent quarter. So right now, if we're collecting for clients, we know Q3 just ended. So we'll usually say current year financial statement at least through June 30th. We're checking for 2 things. We're making sure that the business is continuing the trends that we've seen in the tax returns. And we are also making sure that you're keeping your books up to date, which is very important. Then the next thing that the banker is going to ask you for is a personal financial statement. Really, this is going to be like a balance sheet for you personally. It's going to include any bank accounts that you have, any investments, any real estate that you own, any stocks, any insurance policies, any assets like vehicles, jewelry that has value, or anything like that. So it's basically going to be a listing of all of the items in your life that have value. And what we're looking for there is just that we have a borrower that in the event the business hits hard times, that we have a borrower that's able to continue to support the payment and continue to support that business. The next item is going to be a business debt schedule. So we want to know what other debt is out there on the business, if any. That way we can be conscientious of payments and how much money you already have going out. Other things that could be asked for would be budgets. So if you're doing a construction project, we're going to want to see what does that budget look like, a business plan. So if you're a startup or if you're spinning into a new line of business. So a lot of times we get businesses that they manufacture one thing, they decide they also want to manufacture a second thing, they need money to launch this new product line. We want to see that business plan. How have you determined that this product line is going to be successful? How quickly is it going to take off? All of those things. And again, that's more to show that you've kind of thought through this process and that we're making a good solid loan. Other things you might get asked for would be accounts receivable. So that would be anyone that you're doing business with that owes you money. And again, we're checking to see what is coming in the future. And then also if you're buying equipment, we're going to want to see purchase orders where we're going to see VIN numbers. We'll be able to see the value of the equipment. We'll be able to get some additional information off of that. And then once we have all of that, then we start working on the structure of the loan. That's where it is important to be working with a really good banker because there are lots of different ways to structure a loan. And when we have startups, a lot of times we'll do something like an interest-only period. So while you're getting a project completed or while you're getting a business up and going after a transition or just from the ground up, giving business owners that opportunity to have a lower payment and just pay interest on the loan. We can do some other things depending on when you're getting paid. So some bigger companies, will do things like quarterly payments, or when we've worked with nonprofits before, if we're working on timing things with like a capital campaign where they're raising money, a lot of times we can switch from a traditional monthly payment to a quarterly payment or an annual payment for instances like that. That also happens. Sometimes we have clients that have really big orders that go out kind of once a year. And so if we know a client has a purchase order from a vendor, so we've got an accounts receivable, they've got something they're making, they're shipping, it's a big order. A lot of times we can do a single pay loan when they know the full amount of the loan will be paid upon completion of the project. So then once we determine structure, we have all of the financials, that is when we are going to send this loan into underwriting. And as a salesperson, this is my least favorite part of this whole process, just because I love my clients. I always try to spend them in the best light, and I love to think that everybody's going to pay us back. But this is where the people in the back office are going to crunch all the numbers and make sure that we actually can be paid back. And it's not just Brittany says they're going to pay us back. But they're going to do something called a cash flow and a debt service calculation. So most banks are going to use a global calculation. And what that means is we are going to take all the profits from the business. We're going to take the guarantor or business owner's salary, if they pay themselves a salary, or any distributions that they took. So LLCs frequently will just do business profits at the end of the year, but throughout the year, they may have taken distributions. And so we will add those in there. So we will essentially take all of the money coming in from all sources, and that becomes your cash flow. It's what we have to work with to service all of the payments and things from your business. Then we're going to take all monthly debt payments. That's going to be including personal. So that's going to be mortgages, auto loan payments, any student loan payments, any other kind of term loan payments or any other debt on the business is also going to be included. And then we're going to factor in the payment for the new debt. So if we're putting it on, if you're buying real estate, we're going to do it on a 20 to 25 year term. We're going to figure out what that payment looks like, and we're going to add this into this debt payment piece. And that becomes all of the debt. And then to calculate debt service, we're taking cash flow and dividing it by debt. So how much money do you have coming in divided by how much money you have that's going to need to be going out on a monthly basis. And for most banks, this number is going to need to be 1.25 for conventional. So what that means is that for every dollar of debt that you have, you will need to have $1.25 coming into the business. That can be dropped to 1.15 for the SBA, but the reason that they want that to be over a 1.0 is because at a 1.0, you're not making any money. You are just covering all of the debts. There is no room for error. And a business in that situation is prone to a catastrophic event, which can potentially be very detrimental to them and their long-term success. So we want to make sure that you have enough money not only to cover the debt, but also to continue to operate the business. And then other factors are going to be looked at. We're going to do things like look at credit scores, look at liquidity. So liquidity is going to be how much cash on hand. Again, we're going to look at the business and the personal side, just because in the event that the business takes a downturn, business owners are going to usually inject personal cash into the business to keep them up and going, just because their long-term livelihood is reliant on that business staying in business or staying open. And then industry comes into play more as a risk metric, because certain industries are more risky. So a restaurant is more risky than a manufacturing company or a distribution company. And then I always get this question, but for credit, we're typically looking for credit scores above 650 for secured loans and above 670 for unsecured loans or lines of credit. We're also looking for things like no collections items, at least a year without derogatory payments. So no late payments, 30, 60, 90, any of those. We really need those to be at least 12 months in the past, if not more. And then no judgments, liens, things like that. That's what we're primarily going to be looking for. Okay, so banks are great, but typically banks have a niche that they work in, and not all businesses are going to fit every bank, or sometimes they don't really fit the model for a traditional bank. So one of the things that I've done in my time in the market has been to find partners in outside organizations, because I firmly believe if I can't help you, helping find a resource that can, and keeping your business going, getting you access to what you need is really something that helps everyone in the long run. If your business goes under, I never get the chance to work with you again. However, if I can partner you with somebody that can get you what you need, we have the opportunity to do business, even if it means it's at a later time. So non-bank options here in our market are going to be Community Works. So they are a CDFI, a Community Development Financial Institution. They get large SBA loans and then distribute those funds in smaller loans. They have their traditional side, and they also have a women's business center. Products that they use, they have a credit builder product. So clients that have had credit challenges in the past, they have education, they have loan products, things like that, where they can work with clients who have credit scores below what a typical bank would allow in their portfolio. They also do microloans. So microloans are any loan under $50,000. But what's interesting about them, so Pinnacle will typically go down, I think $10,000 is the lowest we'll go, but they can do loans to $3,000, $4,000, $5,000. So there are some startups, especially service-based industries, where businesses don't need a large amount of capital, they just need a little bit of capital. Community Works, great option there to step in and fill that need. And then they offer business coaching as part of their program. So almost all of their loans are going to require monthly financials and participating in some kind of coaching program. Another option is going to be the SC Loan Fund. Very similar to Community Works. They work with startups. They are typically going to want to take like a second position on a house or some kind of collateral for their loan. But they do work with startups. They do work with businesses that have credit challenges as well. Another really interesting one that's specific here to our market is a company called Vicinity Capital. They do, it's almost like a crowdfunding. They are, it's an alternative investment firm, but investors can use them and their platform to invest in businesses in the local market. They've done some neat projects with some hotels. They've done some restaurants. One thing that's interesting about that is typically if a community is willing to invest in a business, that business will be successful because the community has already kind of wrapped its arms around it. So that one's a really interesting alternative source of capital. And then you always have individual investors. Those are going to be a little bit harder to find just because it's going to be a lot riskier for them. Sometimes business owners go to family or friends to get capital. I typically advise my clients at all costs don't mix business and family. That can tend to get a little sticky sometimes. And same with friends. It's just not usually something you want to walk down that path. If you do utilize individual investors, I definitely recommend using an attorney for something like that. You want to make sure that you have those documents really outlined to lay out the terms, how much you're going to pay back, when you're going to pay it back, and what does that look like, just so that everyone kind of walks away from the transaction a little bit more comfortable and without kind of the guilt that they might have otherwise. And then I wanted to leave time for questions because that's kind of a lot of information at once. And so we usually have questions from people on different types of lending and things like that. So I will take this time and open it up to some questions.
You may just have done a very good job in addressing everything.
Yeah, and I think, I don't know if they can unmute or if anybody, if they have a question, they can put that in the chat.
Yeah, I think they will need to put it in the chat or the Q&A.
Oh, okay.
Okay, and here one just came.
So we have. Yep, I can see them. So the first question, it says, is the 7A interest rate usually a floating rate? Yes, that will depend on the bank, but floating is the most common. Typically banks that will lock the rate on a 7A are going to be your larger financial institutions. So Bank of America, Wells Fargo, big banks like that. And every bank, so the 7A has guidelines, but when you are a preferred partner, your bank's underwriting guidelines then come into play. So a good example is Bank of America does not do startup lending, even though the SBA 7A product is able to be used for startups because their lending guidelines exclude startups. They don't use the 7A product for that. So a lot of times the ability to get a fixed rate will also depend on what type of lending you're looking for. But yes, primarily that is a floating interest rate. But that's a trade-off. So I do a spreadsheet that I send to my clients when we are trying to decide, do we want to go conventional, do we want to go SBA? Because sometimes what it comes down to is what's more important to the business right now. Is it preservation of cash on hand, or is it interest expense over the long run? Because the 7A is going to have the lowest expense up front, but it's probably going to have the highest total interest expense over the life of the loan. So giving clients the ability to see, if you do it through the 7A, here's what your first year cash expenditure is going to look like. if you do conventional, here's what your first year's cash expenditure looks like. That way they can really make the comparison of apples to apples versus, apples to oranges. Okay, and then this says, what would you recommend for a consulting business? It would depend. I mean, I would say that's going to be specific to what that business is looking to do. So if you have a consulting business and you are hiring new consultants, you're probably looking at about 90 days from the time that your employee is hired to the time your employee starts generating revenue for your business. And in that 90 days, if they're a W-2 employee, you're typically going to have to pay them a salary. So a lot of businesses, once they start hiring employees, will utilize a line of credit as a way to fund payroll as that employee starts getting up and going and starts generating revenue for a business. Okay, this says, once called DUNS, is the unique entity ID number something a business should look into? If so, what is it truly used for? What do you recommend for a newly established tax preparation business? So DUNS are typically, I think, Dun and Bradstreet. I have never worked at a bank that has utilized Dun and Bradstreet for making lending decisions. We have access to some of that data, and we use it primarily more for prospecting. It does not factor into our underwriting decisions at all. It did not when I worked at Bank of America either. So it can be expensive to establish with them, and most banks are going to pull a business credit report. Experian is who we pull at Pinnacle. And then what do you recommend for a newly established tax preparation business? Really, it's going to be kind of the same, and it's going to depend, are you working out of a brick and mortar or are you working at your house? Tax preparation usually starts off as a single practitioner. So your main expense is you and your time. So if you're operating out of your house and not hiring employees, your startup costs are probably pretty minimal. And I never recommend taking on debt for just the sake of taking on debt. But again, definitely utilizing a business credit card. That's going to do two things. When the credit card is in the name of the business, you're able to keep your expenses totally separate, which is very important from an LLC perspective. You don't want to pierce that corporate veil because you start losing your liability. But when you do a credit card in the business name, it does not sit on your personal credit profile. It sits on the business's profile. So when you do things like buy a new car or refinance a house or buy a house or things like that, that debt isn't sitting on your personal profile to keep you from getting lending for whatever new purchase you're doing on your personal side. So I am a big advocate of making sure that you keep everything completely separate. This is, I was told they don't use DUNS anymore since the spring of this year. I just don't know enough about that since we don't use them. Like I said, we really use it more of a research because it does give you some information on industry, number of employees, revenue size, that kind of thing. But yeah, I've never worked for a company that's used it as in a credit decision.
It looks like there's a few under the Q&A as well. It looks like Katrina
Okay.
again.
Yep. Okay.
Yeah.
Good. Okay. Okay. So, Chrissy, it says, I'm buying an operating business. The owner is looking to make a profit. How much, if any, can be lent past the inventory and equipment? It will depend on what the existing business can bear. So we have some resources that we use that can kind of give you, they're called multipliers. So there are some industry averages, so like if you have a dental practice and you're going to sell your dental practice, what the rough business valuation would be their profit, and then times whatever the industry multiplier is. Obviously, there's other factors that would go into a full business evaluation, but we typically know, a business owner that's selling their business is looking to make money off of that sale. A lot of times that's the retirement strategy. So a lot of that is really going to depend just on the industry that it is and how much the business can hold from a debt perspective.
Okay, I'm not seeing anything else come in. Are you?
No, I'm
Okay.
not seeing anything else. So if anybody has additional questions, my email is not in there. I can update that and put my email in there. I'm always happy to answer questions. My cell phone's in there. That's typically the best way to reach me. Like I said, we have 6 offices in the upstate. So today I'm at our McAfee office, and my regular office is out at Pelham. But most of the time I'm out on the road meeting with our clients. So cell phone is usually the best way to get in touch with me, or email. And it's just first name, last name, or first name dot last name at pnfp.com. And I can put that here. I can put that in the chat real quick.
Okay, that's excellent. And I'm going to just wrap a few things up here. Let me just, it looks like maybe something else came in, or no, we just have thank you so much and another thank you. So, okay, I think we're good.
Right here. Here is your, yep,
okay.
Thank you.
But Brittany, thank you so much. And I'm going to wrap this up, but that was very, very helpful. Very good information, Perfect. Very succinct. So we appreciate you taking the time to present this. And just to wrap up, I just wanted to give you a little bit more information on SCORE. Again, we're free and we're local. And you can see the website at the bottom of the slide, and you will receive this presentation. But all the advice that we give is personal and confidential. It's one-on-one. Once you sign up, if you need a mentor, we will reach out to you, and you will have one main mentor. And if you have other information that you need, they will bring other resources in. But it's a very good resource. You may just have some very simple questions and may need just for a short period of time, but a very good resource. Okay, Brittany, you want to advance to the next slide? There we go. And also, we are always looking for volunteers, because again, we are 100% volunteer based. We have over 270 chapters across the nation with more than 10,000 volunteers. And you can volunteer in various different roles. The mentors, that's the majority, but we have very specific needs as well. And you can see those listed here. So if you are interested, again, on our website, there is a tab for volunteering. And regardless, take a look at our website. There's a lot of good resources on there. You can sign up there's a workshop calendar through year end that lists the workshops. There's also just other resources that you can explore if you have specific needs. So please take a look at that as well. Okay, and I think one more slide, I believe, Brittany. There we go. And then just this is our social media. So again, you will receive this presentation and a recording. And Brittany just sent you her email address. I will also include that in there as well. And I will be sending the information. So if you have any specific questions for SCORE, you can just respond to that email. But again, Brittany, thank you so very much. It was very helpful. So I'm sure I'm speaking for everyone when I say thank you, and we appreciate your time today. So everyone have a good day, and hopefully Yes, sure. And hopefully we can have you again. I will be reaching out to see if I can schedule you for a few more. So thank you, everyone. And again, if you have questions, Brittany's email will be in the information I send, and she put it in the chat. And you can also, if you have score specific questions, you can respond to the email. But thank you and have a great day.